What's up everyone, it's Scotty with Money Investing. My other camera is having all types of technical issues, so I had to go back to the webcam. So I do apologize for the quality of this video, and I'm trying to get that fixed as soon as possible. So in this video, I wanted to focus on the money flow between smart money and dumb money. Now, you guys know that I don't like those terms at all, so we're going to pretty much be referring to them as institutional and retail, and really help you understand what retail and institutional are actually doing in this market environment while we're seeing this rally play out. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon, of course, is going to be down below if you're interested in joining us, and all the links to our Discord and of course the fundamental and technical analysis courses are currently 40% off. The link's going to be down below as well, and the 16% annual discount does expire at the end of this month. So this right here is some really interesting research that I wanted to share, which pretty much goes over the smart money flow index. And what this shows us is really the smart money, in other words, the institutional buying or selling activity, how active they really are. And at the top, you've got the Dow Jones index, right? So we've got the Dow Jones Industrial Average, and we've got the Smart Money Flow Index at the bottom. And what you'll notice is that when the markets were selling off, and this is back in July, August, September, October of 2022, there was a bit of a bullish divergence in the market where the Dow Jones was making lower lows, but we still had the Smart Money Flow Index continue to make in a higher low, meaning that institutions big money was pretty much buying into as the markets were selling off. And then as we saw this big rally from October all the way till where we are now, I mean, we've really seen the markets go sideways since December, especially for the Dow Jones, and for the S&P, the Nasdaq also have really just been traded sideways. Nasdaq more specifically has done a lot better since October, and it's still obviously a lot higher since October, but in 2023, we've seen the S&P 500 pretty much trade flat. So as the markets have gone sideways, we have seen smart money flow index come down, meaning institutions have been offloading some of their shares, if not a lot of their shares at the moment, as the markets pretty much stay steady at these higher levels. Now, this right here is another really interesting index, which pretty much goes over the US dollar index, normalized positions of smart money. So you'll notice that net positions of large speculators relative to the maximum position of the last 3 years in percentages has once again come down. So we are looking at institutional investors in terms of their US dollar holdings at their lowest levels in 3 years. And we've also seen, of course, the DXY also come down at the moment, right? So we've seen the dollar index DXY come down, and this is another really interesting indicator that they are being more cautious with US dollar investments. Now, this right here is a very good chart about the year-to-date recovery in S&P 500 built on a very narrow leadership, something that we have discussed in our previous videos, and how this market rally is very concentrated among a few names. So what you'll notice is this is broken down by different sectors. So you got basic materials, comm services, discretionary, staples, energy, financials, healthcare, industrial, so on and so forth. And what you'll notice is at the top, we've got, of course, Meta, we've got Nvidia, charging higher, leading the way. We've also got Tesla here, and then a lot of companies in technology with respect to the market cap. Of course, we've got Microsoft, Apple, CRM. So, and of course, Google is going to be here at comm services. So this market rally year to date is very much concentrated in a few names, and we have really seen, the likes of FANG stocks plus Nvidia plus Tesla plus Microsoft being the leaders in a 2023 so far. Now, this is the most telling chart, which I think is quite interesting, which is the smart money, dumb money confidence. Again, we're going to replace those words and call institutional versus retail. And what you'll notice here at the bottom, we've got in red line is the retail activity, right? Retail money. And the blue line is going to be institutional money. And at the top, we've got the S&P 500. So every time we've seen the markets actually go up and we have seen a rally, the retail has been very excited in terms of buying into that rally, right? We've seen retail flows come in according to this chart, and every single peak in retail confidence and retail money has marked a top in the market. And this is going back as far as June, July of 2022. And what you'll notice is that the institutional funds, institutional money has actually almost always been a seller into this rallies, right? We've seen the markets pretty much go higher here, And you can see that institutional, which is the blue line, that's the arrow pointing down, they are coming down, right? So smart money, in other words, institutional money, is selling off. In other words, they're selling into these rallies, as you can see the red line going up. So on one hand, you've got institutions pretty much selling into these rallies, and you got retail buying into these rallies in hopes of the market going higher even further. And right now, as you can see where we are, this is April of 2023. As you can see at the bottom, we're once again in a very similar situation where the markets are pushing higher, and we've got the retail, which is red, right? The red line, once again, approaching some type of a peak, while at the same time, institutional is selling off, right? Institutional is offloading shares and selling into this rally. Now, in the past, I mean, more recently, we've seen, the retail kind of mark that top every single time we get up there, markets start to roll back down. This right here happened back in December. Once again, institutional was selling into that rally, retail was marking that top. This right here happened back in February, where once again retail was buying into that rally, and we had the markets kind of roll over and then started to sell right back down. And you'll notice institutional started buying as soon as markets kind of bottomed out in February. They kind of pulled back a little bit, and now once again we're seeing institutional selling into this rally, and they're really just trading this market volatility, as opposed to retail just pretty much buying into this rally every time we start to move back up. Now, this doesn't necessarily mean that one is right or one is wrong, and smart is better than dumb, and institutionals know what they're doing, because a lot of the times they also don't know what they're doing. So, but this obviously does suggest that there is a little bit of discrepancy there between institutional and retail, and who's really driving this market higher, because oftentimes, we talk about retail as being a very small percentage of the volume, the trading volume in the market, but that's not the case anymore. I mean, retail has really picked up in over the years. Well, especially over the last couple of years, we've seen more and more trading volume come from both retail and institution as well. So right now, just wanted to point out that discrepancy, that we're getting back up to that resistance. There's a lot of other indicators also suggesting the markets can indeed roll over from here, hitting that resistance at the moment for S&P and the Nasdaq. We've got the bond market pushing higher. We've got the volatility at extremely low levels. So it is definitely time for us to be very cautious at the moment. Now, for the bulls out there expecting the markets to continue to push higher, this is something that was posted by Carly Garner. She says that according to the COT report, large speculators are holding the largest net short futures position in the E-mini S&P 500 since 2007. Right? So it's been, that was during the Great Recession, the Great Financial Crisis, when we pretty much saw the market sell off 40-50%. And since 2007, right now, large market speculators are holding on to their largest net shorts on E-mini S&P 500 futures. And either we get a repeat of the financial crisis, or we see a melt up as these shorts unwind their position. Which will it be? Now, one thing this chart really does point out is that, with the only exception of 2007, 2008, the markets have almost always rallied when there has been a large amount of net shorts in by market speculators, right? With the exception of the financial crisis, anytime large speculators have been excessively short on the S&P 500, the markets have rallied, as they have pointed out every single time over here. This is also the case during the pandemic as well. And right now, we're once again dealing with that same situation, where there are pretty significant amount of shorts in the market, and it's really going to come down to where the market ends up going from here. So just wanted to point out some of the liquidity flows. Now, this actually could end up being extremely bullish. I mean, if a lot of these shorts end up covering, and if they cover at higher prices, I mean, guess what? They're going to get squeezed out, and the market's going to continue to just fuel on this rally and continue to push to new heights. But we also have to keep in mind that a lot of this momentum that we're seeing is, number one, coming from a very concentrated handful of stocks, right? Big stocks and big tech and FANG stocks. And number two, it's also coming from a very concentrated area of the market, which is mostly retail. Again, I don't want to say it, but it's mostly dumb money that is actually putting money to work right now. It's kind of buying into these rallies as opposed to institutional, which according to this chart does suggest is selling into this rally, pretty much taking profits on the table, raising cash exposure. So some things that I wanted to point out, and I'll let you be the judge of it. I am still looking at valuations, still looking at the fundamentals for the market, and then of course individual stocks and where those fair values end up being for individual companies. So hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like, subscribe to the channel if you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. And there is a 16% annual discount available till the end of this month. As always, happy investing. I'll see you all in the next video.